China's currency has been brought back into focus as the US Senate passed a bill to put tariffs on certain Chinese imports. Chinese trade data also came out overnight and once again the surplus shrunk. Joseph Tan from the private banking arm of Credit Suisse joins me now to give you the inside track of all things China. Joseph, the yuan has gained 3% this year and the trade surplus is still getting smaller. Could it actually be argued the strengthening of the Chinese currency is hurting exporters?
Well, I think one of the key misconceptions with respect to the currency is that people seem to think that the currency is a major driver of export competitiveness, but in China's case, it goes a lot beyond just the value of the exchange rate. And the exchange rate, quite frankly, is a very blunt tool to try to achieve export gains. And quite frankly, in terms of China, it is really the competitiveness that is available on the labor front that actually keeps the export engine going for the country. We don't think that actually using such a blunt tool to achieve export competitiveness is a sensible move, because China too has quite a high import content. While it has a trade surplus versus some of the more developed countries, it does run a fairly sizable trade deficit versus the rest of Asia. So there is a high import content as well. So to use the exchange rate as a means to achieve export competitiveness will also drive up inflation through the import angle. So all in all, we don't think that actually the currency has a significant bearing on exports to the point that it's a single key driver. There are also other drivers at play with respect to exports.
So if we put falling exports down to weak demand, what options do Chinese policymakers have in this situation?
Well, clearly I think what we are seeing right now is a simultaneous slowing, both in terms of the US as well as in terms of the Eurozone. And naturally, of course, this means that the export demand, not just for China specifically, but export demand as well for the rest of Asia will be affected, because these two regions are very important. I mean, put together, the GDP size is well above 25 trillion. Now, in terms of the policy options available to the Chinese policymakers, I mean, it's very clearly articulated in the 12th China plan, where they do want to shift the key drivers of growth away from exports to one that is more domestically driven, both by domestic consumption as well as investments. Of course, there has been quite a fair bit of concern over investments in China, whether they have gone overboard, whether this is sustainable. Do they have a credit bubble? But we have gone through the figures several times, and we convinced ourselves that we do not see an irreparable credit bubble situation in China at the moment.
The last time I spoke to you was after the interest rate increase, and you were anticipating 2 more hikes this year. Is this a view you still take?
Recently changed that view to one where we are expecting no more interest rate increases for China for the rest of this year, and largely because we have seen a significant deterioration in the external environment for China. But at the same time as well, we're seeing inflation also starting to peak out, both in terms of food inflation as well as energy inflation in terms of oil prices. So I think that is going to be a huge positive in terms of reducing the inflationary pressures for the country, and again as well, less need for Chinese authorities to be raising interest rates on that front. And also, if you look at the domestic sources of inflation, where we have had a significant increase in property prices over the last 18-24 months, we've seen as well recently a retracement in terms of some of these prices, and obviously the reserve ratio requirement hikes that the Chinese authorities have done has succeeded in curbing some of this credit extension, in particular to the property market, and that has seen a softening. So looking at the balance of risk at this point in time, we think that there's no longer a strong pressure for the Chinese authorities to raise interest rates further.
If we turn our attention to Chinese banks now, we saw China's sovereign wealth fund buy shares in China's 4 banks at the beginning of the week. How concerned should we be about the health of Chinese banks?
We looked at, of course, the bulk of the lending that is of concern to the banking sector specifically are the ones that are lent to the local governments, as we've spoken about 6 months ago on that topic. And it's been fairly encouraging, I would say, over the last 6 to 12 months, where the authorities actually have gone through that quite extensively. They have classified those loans and looked at what exactly were these money used for, and how much of it can be labeled as for the good of the nation, and hence can be transferred to the balance sheet of the central government. How much of these need to have increased levels of provisioning for bad loans, and banks in the last 12 months have also raised capital to prepare themselves for that eventuality. So we're actually not too concerned about it, because we've looked at the numbers once again and find that, again, with China's the GDP ratio at about 33% at the moment, even if you do have a transference of all these local government borrowings onto the central bank's balance sheet, you're still talking about a very manageable level, which is about 60% of GDP. That's still very healthy in our view, because China is still growing at a rate of about 9% as an economy. And also the tax revenues that's being generated, the sources of tax revenues is still very healthy. So I think that we have not reached a tipping point where China is at risk of, say, a systemic banking crisis that will affect GDP growth. So, we are more sanguine towards this situation, I would say, with respect to local government borrowings. The other dimensions, of course, that people are quite frankly talking about this moment in time is with respect to the informal lending sector. And there we have looked again at the absolute quantum of it. I mean, the low estimates in the market were placed at about 2 trillion Chinese yuan. The high estimates were placed at about 4 trillion Chinese yuan. And again, if you look at the structure of these loans, typically undertaken by some companies, some individuals, at very high levels of interest rates, I think there is definitely going to be cases of default. But again, it does not transfer itself onto the bank. So you're not going to see a systemic risk as a result of a lot of these loans going into default when it comes to the informal lending sector.
Okay, thank you, Joseph. A comprehensive rundown of the situation in the world's second largest economy there, with the Chief Asian Economist at Credit Suisse Private Bank. Goodbye for now.